exactly the same. Until now. Today, Company A wants to go out and acquire a machine, and the way they're going to do it is they are going to borrow some money from the bank and go with that money to buy the asset. And you notice what happens because of that. They would now have this asset on their books, and they would have this liability on their books. The other company that was identical in every single way wants the same asset. But instead of borrowing money from the bank and buying it, they go to the owner of the asset and they arrange a lease. The lease will last just as long as this other company would own the asset. But if Company B did not account for this asset as something that they bought, there'd be no asset on their books. And if they're not taking out a loan with a bank, there's no liability. But if you think about it, it's the same transaction. Both companies are going to have the use of the same machine for 10 years. Both companies are going to be paying off the use of that asset over 10 years. One of them is going to be paying off the bank. Another one's going to be paying off the lessor or the owner. So basically, it's the same transaction. So generally accepted accounting principles say that Company B is basically doing the same thing as Company A, so we need to make them look like Company A. So when we get to a problem here pretty quick, you're going to see that if it's a capital lease, this company is going to put the asset on their books as if they own it, and they're going to put a liability on their books just as if they borrow money from a bank. Now, it says here that this kind of accounting is okay if we're talking about an operating lease. If it's an operating lease, we don't have to put assets and liabilities on our books. Well, what's the difference between a capital lease and an operating lease? This next page in your packet is one of those summary pages, but I want us to look at the capital lease criteria. What's going to happen is the company's accountants are going to look at the contracts, the lease contracts, and they're going to see if that lease meets one of those four criteria. But in a nutshell, the difference between a capital lease and an operating lease is a capital lease is a long-term arrangement. You want a car, but instead of buying the car, you sign a 5-year lease. An operating lease is a short-term arrangement. You all go on spring break and you want to rent a car for a week. 5-year lease with the car dealer, maybe a capital lease. Renting a car for a week on spring break, operating lease. That's basically what we're talking about. So, these four criteria that you see up there, only one of them has to be true in the lease contract. If any one of them is true, the accountants are going to say we have to account for this like a capital lease. The first one, it transfers ownership. In other words, you lease my car from me, and at the end of X number of years, it's yours. Take the keys, it's yours now. I transferred ownership to you. The second one, it has a bargain purchase option. Now, a bargain purchase option means that the bargain is such a bargain that you wouldn't turn it down. You lease my car from me for X number of years. After that, you can buy it from me for $1. So you lease it, and after so many years when the lease is up, you say, I don't like that car, I don't want it. But for $1, I'll buy it and sell it to somebody else and make some money. So in a sense, you will become the owner, if not long-term, at least temporarily. The third criteria, you're leasing the asset for more than 75% of its life. And finally, the present value of what you're going to pay in terms of lease payments is at least 90% of the asset's value. All four of those criteria are either implying that you are going to become the owner of the asset or basically going to use it the majority of its life, or the amount that you're paying for it is basically like buying it. So if any one of those four criteria are true about the lease, it's got to be accounted for as a capital lease. And as you're going to see in a minute, that means that even though you don't own it legally, you put it on your books as an asset, and you put the liability on your books as if you borrowed money to acquire it. Any question about that? Okay, let me show you a problem, capital lease problem. January 1, 2009, Sprinkles Company signs a capital lease to lease equipment from Tabor Company. The lease is for 2 years and requires lease payments of $10,000 at the end of each of the 2 years. The interest rate in the lease is 8%. Sprinkles depreciates its assets using straight line depreciation. The first thing we would have you do is determine how much should go into the asset and the liability accounts. Because it's a capital lease, you're going to increase your assets and your liabilities as if you bought this thing with borrowed money. The amount is going to be the present value of the lease payments. They're making $10,000 payments each year for 2 years, and you're going to use 8% as the discount rate. So what I'm going to show you here in terms of the amount, $17,833, that is the present value of $10,000 each year for the next 2 years, if the interest rate you're using to define present value is 8%. So again, when you look at that, this is exactly what a company would do if they bought this asset with borrowed money. They'd put the asset on their books and they'd have this liability that they have to pay off. Capital lease accounting is structured to look the same way. Now that you have the asset on your books, notice what Part 2 says. Compute the depreciation expense for each year. Well, if you've got the asset, you depreciate it. And with capital leases, you depreciate using the straight line technique. And you have a zero salvage value because after the lease term is up, there's no more value to the lease. So what we're going to do is we're going to take $17,833 as the original cost, zero salvage value, and we spread it out evenly over 2 years. So we're going to have depreciation expense, and I rounded up here, to $8,917. That'll show up on our income statement as depreciation expense. We're depreciating an asset as if we own it. Now I'm going to give you a choice for the other account. You can either, like we did back when we depreciated buildings and equipment, you could, if you wanted to, as the other account, increase something called the accumulated depreciation. That'd be fine. Walmart did that on their balance sheet. Or you can do what I did up here and just take that amount out of the capital leased asset account. Either way, you're reducing the value of the asset. Either increase accumulated depreciation, that's contra asset account, or go ahead and take it out of the capital leased asset account. So, we've got an asset on our books that's being depreciated, just like we've owned it. Notice up here it also says compute the interest expense each year. Well, we've got this liability that we're paying off. A debt that we're paying off that is incurring interest expense. What we're going to do with that capital lease liability is exactly like we treated installment debt back at the beginning of class on Tuesday. If you remember when we talked about Sprint and Citibank, when Sprint borrowed money from Citibank, they made payments every quarter for 2 years. You remember that every time they made a payment, part of it was interest and part of it was paying off the debt. That's what we're going to do here. Does anybody remember how you determine how much of a payment is interest expense? What do you multiply together to get interest expense on installment debt? Raise your hand if you know. I see a few of you looking through your notes a little bit. Feel free. See if you can find what we did with the Citibank Sprint loan. You remember? Good. He said whatever the liability was times the interest rate. So in this case, the liability is $17,833. The interest rate is 8%. That tells you how much of the payment is interest. Now remember, the payment was $10,000 in this problem. They're making a payment of $10,000. So cash is going to go down by $10,000 when they make the payment. But of the $10,000, we need to decide how much of that is interest expense. If you can see that, it says $1,427 is interest expense. How did we get that? Just like you told me. We took the value of the liability and multiplied it by the 8% interest rate. So $17,833 times 8%, that's the interest portion of the payment. We're not paying an additional $1,427. This is what we're going to pay. That's what the lease contract says. The payment is $10,000. But of the $10,000, $1,427 is interest. And that means the remaining $8,573 is paying off the debt itself. Remember again with Citibank and Sprint. Every time Sprint made a payment, part of the payment was interest, part of it was to pay off the debt itself. Any question about this? Now I've got some supporting numbers down here that show you where those calculations came from. Notice that at the end of the first year, what's in the asset account is $89.16. When we depreciate the second year, we would depreciate the remaining $89.16, and the asset account would eventually be zero at the end of the 2-year contract. When we make the second payment, who can tell me how we're going to come up with interest expense? Go ahead and tell me what two numbers you would multiply together to get the interest expense in the second year. Raise your hand if you can tell me what two numbers you would multiply together to get the second year's interest expense. What do you need to multiply together to get the second year's interest expense? Yeah. The interest rate being 8%, and you want to multiply that by the remaining value of the asset. You want to multiply it by the remaining value of the liability. Whatever it is you owe at the time, in this case it's $92.60 after the first year, that's what you're multiplying by the interest rate to get the interest expense for the second year. Interest expense is always what you owe at the time times the interest rate. So with the first payment, we paid off $85.73 of it. So we no longer owe $17,833. We owe $92.60 to start the second year. We make another $10,000 payment. Of the payment, how much is interest expense? $92.60 times 8%, which I think would be about $740. Any questions about this? Question? Okay, that's good. Yeah, question? What about that interest expense? The $14.27 is the interest expense. It's the portion of the payment that is interest. The depreciation expense is based on the value of the asset that we're spreading out over, in this case, 2 years. Other questions? Let me put you to work then. I've got a problem for you to do. This is the Raylor Company. On January 1, 2009, they signed a capital lease to lease a machine. The lease is for 3 years. Requires lease payments of $20,000 per year at the end of each year. The interest rate in this lease is 6%. They use straight line to depreciate their assets. In part number 1, says compute the amount that Raylor would show in the asset and liability accounts. I want you to do that. But the second part of number 1, discuss how recording this lease will affect their debt ratio and return on assets. Don't worry about that. We'll talk about it together when you're done. Don't worry about that as you're working. I do want you to do number 2. Tell us what the depreciation expense and the interest expense would be each year during the 3-year line. If you have questions, let us know.